The trough is a moment in the economic cycle that commands our full attention. It represents the lowest point of business activity. It represents the lowest point of market sentiment. This is the time when pessimism is most pervasive. News headlines are typically at their worst. Investors who were once confident now feel the sting of deep losses. The prevailing emotion is fear. The impulse to sell everything is powerful. Many capitulate, believing that the pain will never end. This widespread sense of hopelessness is a hallmark of the bottoming process. It is a period defined not by data, but by psychology. The air is thick with dread, and the future appears bleak to almost everyone. However, for the thoughtful investor, this very environment presents a unique proposition. The trough is not just an end, it is also a beginning. It is the point from which a new recovery will eventually emerge. When prices have fallen substantially, they often reflect an excessive amount of bad news. The possibility of further decline is priced in. The potential for future improvement is often ignored. This is where opportunity is born. One of the most important signals to watch for is an improvement in economic data. During a downturn, economic reports consistently disappoint. Rising unemployment, declining manufacturing output, falling consumer spending. The news is a relentless drumbeat of negativity. The first sign of a potential trough appears not when the data turns good, but when it simply stops getting worse at an accelerating rate. For instance, the number of new jobless claims might still be high, but the week-over-week increase begins to shrink. This subtle change is a critical inflection point. It is the earliest indication that downward momentum is beginning to fade. This deceleration is often overlooked. Most people wait for unequivocally positive news. They want to see headlines that job growth has returned or that GDP is expanding. By the time those headlines appear, markets have often moved higher and opportunity has passed. The astute investor watches second derivative changes. The rate of decline is slowing. The negative slope is becoming less steep. A second crucial signal is the broadening of market gains. In the early stages of a potential recovery, a rally is often led by a very small number of stocks. Highest quality companies, those in defensive sectors that have weathered the storm best. This initial move can be deceptive. It is narrow and lacks conviction. However, a true bottoming process is confirmed when the rally begins to widen. This is what we call improving market breadth. Instead of just a few dozen stocks moving up, we start to see hundreds and then thousands of individual stocks participating in the advance. The tide is beginning to lift more boats, not just the most seaworthy yachts. This broadening participation is significant because it reflects a fundamental shift in investor psychology. It shows that capital is moving from a position of extreme risk aversion toward a willingness to take on more exposure. Investors are no longer just hiding in the safest corners of the market. They are beginning to see value in a wider array of companies, including those in more economically sensitive sectors that were hit hardest during the downturn. When these signals begin to align, stabilizing economic data, broadening market participation, accommodative monetary policy, it may be tempting to invest all your available capital at once. This would be a mistake. The presence of these signals indicates that the environment is becoming more favorable, but it does not eliminate risk. Recoveries are rarely smooth, linear affairs. There can be false starts, pullbacks, and periods of renewed volatility. The most prudent course of action is to begin investing gradually. This strategy, often called dollar cost averaging or scaling in, allows you to take advantage of low prices without betting everything on the belief that you have timed the bottom perfectly. As an example, an investor could decide to deploy a portion of their cash, perhaps 20% or 25%, after observing the initial signals. Then, they should wait and continue to monitor the data. If the positive trends continue and the market holds its ground or moves higher, they can commit another portion of their capital. This methodical approach has several benefits. It mitigates the risk of buying too early, just before another significant leg down. It also imposes a discipline that helps to control the emotional impulse to go all in out of a fear of missing out.